Hello dear students, in this video we are going to see the credit analysis, one of the most important topic of agriculture, finance and insurance. Myself Professor Vaishali Bharat Gholap. In India, most of the farmers have the limited capital. The farmers need credit at right time through right agency and in adequate quantity to realize maximum productivity. In contrast to the farmer's point of view, when farmers approaches and financial institutions with a loan proposal, the banker should be convinced about the economic viability of the proposed investment. How they judge the economic viability of the investment? These three questions answer is represented the economic viability of the proposed investment. Will it generate return more than cost? Will the returns have surplus to repay the loan when it falls due? Will the farmer stand up to the risk and uncertainty in the farming? These are nothing but these three questions represent the three R's of credit. First is return from investment, repayment capacity and risk bearing ability. Return from the proposed investment, repayment capacity, the investment generate and risk bearing ability of the farmer's borrower. One by one we are going to see. These three R's of credit represent the are the sound indicators of the credit worthiness of the farmers. Return from investment. This is an important measure in credit analysis. The banker needs to have an idea about extent of returns likely to be obtained from the proposed investment. Farmer's request for credit can be accepted only if he can be able to generate return that enable him to meet the cost. Return obtained by the farmers depend upon the decisions like what to grow, how much to grow, when to sell and where to sell. Therefore, the main concern here is that the farmer should be able to generate incremental return that should cover the additional cost incurred with borrow fund. This is the first R of credit, that is return from investment. Now, repayment capacity. What is meant by repayment capacity? Repayment capacity is nothing but the ability of farmers to clear off the loan amount obtained for productive purpose within the time stipulated by bank. Okay. At the time, the loan may be productive enough to generate additional income but may not be productive enough to repay the loan amount. Hence, the necessary condition is that the loan amount should not only profitable but also have a potential for repayment of the loan amount. Under these conditions, farmers will get the loan amount when return from the investment is depend upon the various factors. One by one we are going to see what is x1, x2, x3, x4, x5, x6. x1, x2, x3, x4 are the quantifiable factors, means which we can quantify, and x5, xc are the qualitative factors. Okay. Here y is a dependent variable, that is nothing but the repayment capacity, and x1, x2, x3, x4, x5, x6 are independent variable. Okay, x1 is this sign represent the impact of that variable on repayment capacity. Okay, if gross return increase, that will automatically increase the repayment capacity. Okay, x1 is a gross return from enterprise for which loan taken during a season or year in rupees. Then working expenses. If there are increase in working expenses, automatically repayment capacity will be decrease. X2 is working expenses in rupees. X3 is family consumption expenditure. When it increase, it will automatically decrease the repayment capacity. That's why their sign is minus. Other loan due also affect negatively on repayment capacity. That is X4. X1, X2, X3, X4 are measured in the unit rupees. That's why that is quantifiable. Or then X5 and X3, literacy and managerial skills, affect the repayment capacity positively. If there is a higher literacy level of the farmer, sorry, automatically it will increase the repayment capacity. Higher managerial skills, if the farmers have, that will also affect positively the repayment capacity. This equation represent the repayment capacity and various factors affecting the repayment capacity. Okay. Hence, even though the returns are high, the repayment capacity is less because of these various factors. That's why that is seen before sanctioning the loan by the bank. The repayment capacity vary different for the crop and different for the term loan. Okay. Repayment capacity for the crop loan, how we can calculate? First, gross income. From gross income, we need to subtract the working expenses, family consumption expenses and other loan due, and we have to add other miscellaneous expenses that will give the repayment capacity for crop loan. Okay. Now, what are the different causes for poor repayment capacity for Indian farmers? There are different causes of poor repayment capacity of Indian farmer. First and most important cause is small size of land holding due to fragmentation of land, then low production and productivity of the crop, high family consumption expenditures, low prices or rapid fluctuation in prices of agricultural commodity, using credit for unproductive purposes, low family equity or net worth, low farmers equity or net worth, lack of adoption of improved technologies and poor management of limited farm resources. These are the causes for poor repayment capacity of Indian farmers. Now, what are the measures for strengthening the repayment capacity? How farmers can increase the repayment capacity? First and most important measure is increasing the net income by proper organization and operation of the farm business. Then adopting the potential technologies for increasing the production and reducing the expenses on the farm, then removing the imbalances in resource availability, then making the schedule of loan repayment plan as per the flow of income, then improving the net worth of the farm household, diversification of the farm enterprises, also adoption of risk management strategies like insurance of crop, animal and machineries, hedging to control the price variation. These are the different measures for strengthening the repayment capacity. Clear repayment capacity. Now we are going to move forward to next R, that is risk bearing ability. Risk bearing ability is the ability of the farmers to withstand the risk and arise due to financial loss. Risk bearing ability is the ability of the farmers to withstand the risk that arise due to financial loss. There are different types of risk: production risk, technological risk, institutional risk, personal risk, weather risk and price risk. Okay. Risk under repayment capacity under risk is calculated, that is deflated gross income minus working expenses excluding the proposed crop loan, family living expenses, other loan due and miscellaneous expenses. Then when we subtract all these expenses from the gross income, we will get the repayment capacity under risk. Now, what are the different measures to strengthen the risk bearing ability. How the risk bearing ability can be increased by the farmer? First and most important measure is farmer have to increase the owner's equity or net worth, then reducing the farm and family expenditures, developing the moral character, that is honesty, integrity, dependability, feeling the responsibility. All these qualities put together are also called as credit rating. Then undertaking the reliable and stable enterprises, or choosing such enterprises which give the guaranteed and steady income, and improving the ability to borrow fund during good and bad times of crop production, improving the ability to earn and save money, as part of the farm earnings should be saved by the farmer so as to meet the uncertainty in future, and taking up crop, livestock and machinery insurance. These are the measures for strengthening the risk bearing ability. Here we have completed the 3 R's of credit: repayment capacity, risk bearing ability and return from investment. Now we are going to see the 5 C's of credit. Okay. 5 C's of credit are character, capacity, capital, condition and common sense. Character. Okay. Character is the basis for any credit transactions. Basis for any credit transaction is trust. Even though the bank insists upon security while lending a loan, an element of trust by the bankers will also play a major role in sanctioning the loan. The confidence of an institutional agency on its borrower is influenced by the moral characters of the borrowers like honesty, integrity, commitment, hard work, promptness. Therefore, both mental and moral character of the borrower will be examined while advancing loan. Generally, people with a good mental and moral character will have a good credit character as well. That is character. Then capacity. Capacity, it means capacity of an individual borrower to repay the loan when they fall due. It largely depends upon the income obtained from the farm. The capacity is the function of income, which I have explained in the previous slide, that is repayment capacity. Y is equal to. Okay, capacity clear. Now capital. Capital indicates the availability of money with farmer borrower. When his capacity and character are proved to be inadequate, the capital will be considered. It represents the net worth of the farmer. It is related to the repayment capacity and risk-bearing ability of the farmer borrower. That is capital. Then condition. It refers to the conditions needed for obtaining loan from financial institutions, that is procedures to be followed while advancing a loan, that represent the condition. Then common sense. Common sense, this relate to the perfect understanding between the lender and the borrower in credit transactions. This is in fact prima facie a requirement in obtaining credit by the borrower. These are the 5 C's of credit. Now we are going to see the 7 P's of farm credit, or principle of farm finance. 7 P's of credit and principle of farm finance. Principle of productive purpose. See, first of all, before that, the increased role of financial institutions due to technological changes on agriculture from necessitate the evolving the principle of farm finance, which are expected to bring not only the commercial gain to the bankers but also the social benefit. The principles so evolved by the institutional financial agencies are expected to have the universal validity. These principles are popularly called as 7 P's of farm credit. These are principle of productive purpose, principle of personality, principle of productivity, principle of phase disbursement, principle of proper utilization, principle of payment and principle of protection. Principle of productive purpose. Okay, here the principle refers that loan amount given to the farmer borrower should be capable of generating additional income. Okay, based on the level of own capital available with the farmer, the credit need vary. The requirement of capital is visible on all farm but more pronounced on marginal and small farm. The farmer of these small and tiny holding do need another type of credit, that is consumption credit, so as to use the crop loan productively without diverting from them for unproductive purposes. That's why this principle convey that crop loan of the small and marginal farmers are to be supported with income generating assets required through the term loan. The additional income generated from these productive assets add to the income obtained from the farmings and thereby increasing the productivity of crop loan taken by small and marginal farmers. Okay, we can here example is loan for dairy animal, sheep and goat animal, poultry, birds, installment of pump set on group action. These are the example, relevant example for explaining the principle of productive purpose. Then principle of personality. The 3 R's of credit are sound indicators of creditworthiness of the farmers. Over the year of experience in lending, the bankers have identified an important factors in credit transaction, that is trustworthiness of the borrower. It has relevance with the personality of the individual. When farmer borrower fail to repay the loan due to the crop failure caused by the natural calamities, he will not be considered as a willful defaulter, whereas a large farmer who is using the loan amount profitably but fail to repay the loan is considered as a willful defaulter. This character of the big farmer is considered as a dishonesty. Therefore, the safety element of the loan is not totally depend upon the security offer but also on the personality or credit character of the borrower. That is principle of personality. Okay, then principle of productivity. This principle underlines that the credit which is not just meant for increasing production from their enterprise alone, but also it should be able to increase the productivity of other factor employed in that enterprise. For example, use of high yielding variety in crop and superior breeds of animal not only increase the productivity of the enterprises but also should increase the productivity of other complementary factors employed in the respective production activity. Hence, this principle emphasizes on making the resources as productive as possible by the selection of most appropriate enterprise. That is a principle of productivity. Then principle of phase disbursement. This principle underlines that the loan amount needs to be disbursed in phases so as to make it productive, and at the same time bankers can also be sure about the proper end use of borrowed fund. For example, loan for digging well. The phase disbursement of loan amount fit for taking up of cultivation of perennial crop and investment activity to overcome the diversion of funds for unproductive purposes. But one disadvantage here is that it will make the cost of credit higher. That's why the interest rate are higher for the term loan when compared to the crop loan. Then principle of proper utilization. Principle of proper utilization. Proper utilization implies that the borrowed funds are to be utilized for purpose for which the amount has been lent. It depends upon the situation prevailing in the rural area where the resources like seed, fertilizer, pesticides are free from adulteration, whether the infrastructure facilities like storage, transportation, marketing are available. Therefore, proper utilization of fund is possible if there exist suitable conditions for investment. That is the principle of proper utilization. Principle of payment. This principle deals with the fixing of repayment cap schedule of the loan advanced by the institutional financial agencies. For investment credit, advance to irrigation structures, tractors, etc., the annual repayments are fixed over a number of years based on the incremental returns that are supposed to be obtained after reducing the consumption needs of the farmers. With reference to the crop loan, the loan is to be repaid in lump sum because the farmers will realize the output only once. A grace period of 2 to 3 months will be allowed after the harvest of crop to enable the farmers to realize reasonable price for his produce. Otherwise, the farmer will resort to distress sale. When crop fail due unproductive weather conditions, the repayment is not insisted upon immediately. Under such conditions, the repayment period is extended basis assisting the farmers with another fresh loan to enable him to carry on the farm business. This is the principle of payment. Then principle of protection. Because of unforeseen natural calamities striking farming more often, institutional financial agencies cannot keep away themselves from extending loans to the farmers. Therefore, they resort to safety measures while advancing loan like insurance coverage, linking credit with marketing, providing finance on production of warehouse receipt, taking security, bank advice, advance loan either by hypothecation or mortgage of asset, and credit guarantee. Okay, when bank fall to recover loan advance to the weaker section, Deposit Insurance Credit Guarantee Corporation of India reimburse the loan to the lending agency on behalf of borrower. These are the principle of protection. Here we have completed the credit analysis. Credit analysis include 3 R's of credit, 5 C's of credit and 7 P's of credit. Thank you.